Alrighty, folks. When the stock market goes red, one of the guys I reach out to is Taylor from LifeGoal Investments. Again, a 12-year veteran of Wall Street and just an all-around good guy who's putting out 60-second content to really educate the masses. And Taylor, you did a 3-part series on Friday that deserves, I don't know, an Emmy or whatever it is for short form content. You did a great job of breaking apart 3 pieces of economic data that probably collectively led to a pretty brutal red day and looks like some follow through Monday morning. But let's break down what the 3 are. Let's get into the details and really figure out, are they important? Are they a sign? Are they noise? What were they? Go in any order you'd like.
Yeah, so you're right. It was a nasty day in the market. It was a confluence of 3 things that just happened to hit bang, bang, bang all in the same day. And it created a pretty violent downward day. I think one could be argued that it was noise. And that is the first one, which is inflation. So really, you have seen inflation tick up over a 3-4 month period of time now, where it went from meaningfully moving downward to hitting a bottoming point and reaccelerating. And it's not reaccelerating at a nasty pace, but rate of change is just moving the wrong direction.
Agreed.
And but what came out on Friday was inflation expectations. So 5 years out, what is the market expecting inflation to be? So the University of Michigan goes out and surveys a bunch of folks and they say, what do you think? And so the interesting thing is, even when inflation was nasty 2 years ago at 9%, 2.5 years ago, the forward inflation expectation was still modest. And it was at 2.7% when inflation was at 9%. Now inflation is in that 3% ballpark, and they're saying 5 years out, inflation is 3.5%. So it doesn't sound like a huge number until you realize that's the highest inflation expectations 5 years out that there's been since 1995.
Yeah, it's a why. Again, that was really interesting to me, because the other thing that I watch for in the market is when a trend breaks.
Right.
And I believe I saw this on Friday, but again, you're far more in this than me. So for the last 12 to 18 months, when inflation expectations rose, we seemed to have a pretty good follow through in the long end, aka the 10-year went up. That broke Friday and broke meaningfully, right? Because again, the report says that we've had the largest rise in inflation expectations 5 years out since the 90s.
Right.
But the 10-year note went down hard in rates on Friday. That shocked me.
That's counterintuitive.
It breaks trend. So what the hell?
Yeah, because typically when you think about the 10-year treasury, the 10-year treasury movement upward is going to be predicated on inflation. So when 10-year treasury rates rise, oftentimes it's because the market thinks there's going to be inflation in the future, which drives that bond price lower. But what happened was that was event number 1. There was 2 more.
So let's finish on one, because the one thing I was thinking about, and again, that's why I saved this conversation for you, is the survey, as I understand it, was a consumer survey.
Correct.
Right. So again, I think it's fair to say that the average consumer is not.
Don't
deep.
Put it too bluntly.
It's not deep in economics, right? They have been hearing tariff. Tariff is a tax. Tariff is bad. So the consumer is being leaned that direction.
Yep. Fair.
When I think about the 10-year, that's the smart money.
Correct.
Not consumers.
Correct.
And I think what the smart money is saying is, this consumer 5-year thing is a blip. It's going to self-correct in a month or 2 when the tariffs don't show up. So it's noise to be ignored. But yeah, I had to think about that for a minute, because it broke trend.
Well, what's also interesting is that Powell's favorite line to use over the past several years is inflation expectations have remained well anchored. And that bucked that trend, right? All of a sudden now, if you have inflation expectations coming unhinged, and Powell taking that as a very serious signal, which is what he has done, or at least alluded to the fact that he's doing, that then breaks that particular line of thinking. And so it creates more of a question mark around, okay, well, what happens with interest rates moving forward if inflation expectations are coming unhinged? And it's 1 month worth of data. And it is a little noisy because it is consumers, but nonetheless, it's something to be aware of. And what it says is if you have inflation expectations going higher and yet 2 weak economic data points come out in the same day, it starts glaring a little bit of that stagflation light.
I'm with you. Yeah. So again, I think what happens again, I had to think about this for a while. I think the consumer 5-year expectation self-corrects in a month or two or is revised away or whatever the right, words are.
I
So,
think
okay,
it's
that's
all
number
being
one.
dependent upon whether tariffs are a bargaining chip or a battering ram, right? And right now it seems like they are a bargaining chip, but the market's scared that they might be a battering ram.
Correct. I think that's very well said. And again, the consumer in this case is hearing battering ram, and acting accordingly. I think when they realize that most of them are bargaining chips, that will self-correct. All right, so that's number one. What was number two?
Number 2 is housing. This is your area of expertise. And number 3 is going to be the biggest one, by the way. We'll get to that. But number 2 is housing. And what we saw was just houses are not turning over, right? And you've been, pounding a dead horse, beating a dead horse on this. But the reality is the economic flywheel that home sales creates is unrivaled by almost anything else in the market. Because when you buy a home, you're going to have, boom, a mortgage sent to you. So you're getting lenders involved. You're getting bankers involved. You're getting movers involved when you start to move. You want to rehab that house. So you're going to paint it and spend money at Home Depot. You're going to have furniture come in. You're going to have landscapers redecorating. And it just creates this compounding domino effect of what it does to the market. When you look at housing, it represents a pretty small portion of the overall economic output of our country. But then when you put the compounding effect on it, it can be anywhere up in that kind of 15 to 20% of our overall economic output. And when houses aren't moving, that flywheel is not turning.
Yeah. Again, I think housing, I've been very clear, I think has one more rough year. This is the bottoming. This is the basing. And then the good news is we have a decade of year-on-year growth ahead of us.
Right.
But yeah, we got one more hard year. We got January numbers, 4.05. I think they were, less than I thought they'd come in sub 4, so I missed that one. But yeah, it's not going to be anything to write about home on housing, existing home sales for at least the next 6 months. But yeah, housing number was bad. But that's how you put in a bottom. So I think that's where we are.
Yeah, and I hope that to be the case as well. It'll be interesting with the movement downward in the 10-year that came along with Friday's economic data. Obviously, that makes mortgages more affordable. Yeah. It doesn't snap overnight, but it happens pretty darn quickly.
Yeah, to your point, we're below 7. Again, yeah. I've said for a long time that 7 bad, 6 is good. We got 6 handles. We have the ability to buy to a 5 handle these days. Rates are down again this morning. I called the average for 30-year mortgages 7% for 2025, and given what's going on now, that there's a very good chance I'm going to be wrong, right?
Yeah, that will be a welcomed Michael Zuber being wrong.
Absolutely, yes. For the folks in the real estate industry, I've never been. Nobody wanted me to be wrong more than people in real estate. So there we go.
And I think that your comment remains really strong. Like if realtors were able to weather this storm, they're going to be in a good spot.
Because their competition's gone. Because they're going to gorge like a buffet.
That's it.
Yeah, in 26. So good news is you only got 10 months left. February, dude. What happened in 2025? February is almost over. Wild.
We're cooking, baby. We're cooking.
All right, let's get into the big one. This is the one, and I actually think most people missed it. This is like a big red light going problem.
Yeah. Well, that's because what the hell does services PMI mean?
Right? Yeah, people don't get it, right? It's everything to the U.S. economy.
It is. So when you think about our economy, largely speaking, you can split it in 2 different buckets, manufacturing and services. And so we've actually had a contraction in the manufacturing space basically perpetually since COVID. And so the manufacturing has really taken it on the chin. But what has been the bellwether to the economy are the services. And so services have been really strong. So think about everything from hotels, restaurants, airlines, transportation, Technology also falls in services, as does finance fall in services. So that actually generates about 77-78% of our overall economic output. And what you've seen is post-COVID, money in people's pockets. They're traveling, they're buying financial products, they're using banks, et cetera. And so that part of the economy has been outstandingly strong, even making up for the contraction that we've had on the manufacturing front until Friday. And on Friday, this number is very easy to understand. 50 is the number. If it comes in above 50, services are expanding. 78% of our economy is expanding. If it's beneath 50, it's contracting. And it contracted. And that was the first time it contracted since back in late 2022. And if you remember in late 2022, that's when the market was in a really nasty point and everyone said recession coming, recession coming, recession coming. So this is now a renewal of that fear of, hey, maybe those stimulus checks are now gone and people aren't incredibly flush with cash like they were. And that's going to slow the overall economy, of which services make up 78%.
Yeah, again, if you wanted to cause a recession in the United States, you don't go after manufacturing. It's not big enough. You go after services. And how do you do that? You just have to break consumer psychology. Consumers are fragile, right? If they're, if we have this wealth effect, if we have, net positive, growth, we spend, but we can get scared really quickly. And you're seeing a great example of that today with federal employees, right? Federal employees, I did some research, make up roughly 2% of all employees.
Mm-hmm.
You have 2% of the economy right now not spending. They're
Totally.
just not spending, right? They don't, and most of them won't get laid off, but they're all afraid that they're going to get that notice or tap on the shoulder. So you have 2% of the economy not spending, right?
Let me interject something further here, because 2% of the economy is direct federal employees.
Correct.
But I have family members that work for government contractors.
Yeah.
And they absolutely are feeling the same thing, where they're tightening their purse strings because they don't know whether this is going to spill over from federal employees to, okay, if they're not needed as much, am I needed as much as that second iteration out?
Yeah. I just don't have any good numbers on that, right? So if you have to, let's assume, I don't know, let's just assume federal employees are 2 million, like direct employees.
Yep.
Would it be fair to estimate that contractors or that second order is what, 5x that?
I was going to say it's got to be a multiple of that.
Right. Has to be,
I don't know what that number is, but yeah, I mean, all of a sudden you start to say, okay, the engineers for the government organize a new rail system from somewhere to somewhere. Then someone else comes in and builds it. And oftentimes that's not a government worker.
Yeah, because I'm thinking about, so again, I ran sales for a long time. So I'm gonna give some rough numbers from memory. So when I was running software companies, we would always have a commercial segment, like an enterprise segment.
Right.
We would have public education, and then we would have government, which would be federal and state. And if I remember the quotas correctly, the federal quotas were always like 15 to 20% of the company number.
Okay.
So, I mean, if you kind of play that out, because there's just so many orders of this, right? There's the direct employees, then there's the contractors, and there's the people that service the contractors and employees, and there's the software. I mean, we could be, I don't know, we could be 25% of the economy right now is kind of puckered up because of all this. Perhaps maybe 20%. I don't know, something like that.
Yeah. And it just comes from an extreme on the opposite side. I think where you had, literally just checks getting mailed to people. So you go from this extreme, gambler, let's take it to the roulette table and roll it mentality. Let's travel, let's do all of those things, to now, okay, I might not have a job. And fear is a incredible, strong budgetary item, if you will.
Yeah. And if you tie this in with housing, which was point number 2, this does not help, because again, people don't understand that housing demand turns off in an instant.
Yeah.
And, contracts get canceled in an instant.
Yep. Yeah.
And, this is going to have, now it won't be national, right? But it will have a cooling effect on a lot of the country.
Well, I think what this is doing is starting to play out kind of the policy uncertainty that's in the market right now, where the market is euphoric about the policy changes that are coming, that over the long term, they're going to do really productive things for our economy. But short term, and I think Trump himself would be willing to admit this, there might be some pain that get us
Oh,
through
I
here.
think they've said it.
Yeah.
They've explicitly said it. I believe Trump and Musk have both said, their nirvana, the heaven that we all want is, we got to get through some pain first, right? Short-term pain for long-term gain. And I have said, since the opening, that the first 6 months of this year are going to be chaotic and likely painful.
What's interesting, though, is the stock market is always perceived as the ultimate forward economic indicator, where it looks out into the future and says, we're going to discount risks that are coming. But the market hasn't done that whatsoever. It waited until on the screws of the day, hey, services doesn't look good anymore, which is 78% of our economy. We're going to hit the sell button. Wednesday, we were at all-time highs, literally at all-time highs. And if you look at stock market valuations right now, they're still, even after a little bit of a puke of 1.5% on Friday, they're still incredibly frothy. So the market really has not been all that concerned. Friday was just a little bit of a backhanded slap in the face that I think the market, finally said, okay, maybe there is some intermediate short-term pain to be had to get us to the long-term destination.
Yeah, and if we kind of talk about the open this morning, it actually opened up, but I believe all indices are now trading down. And what I saw right before I hit the record button with you is the VIX is now over 20.
Yeah,
it had been flat forever. I think it went to 17 on Friday. It's now over 20. Yeah. Is that a harbinger of more fear in the market?
Yeah, so it's not necessarily a causation. That is more of a side effect of fear in the market, right? It just is reflective of the fear that's being experienced. But oftentimes what they refer to as a VIX over 20 is 20 to 30 is what they call a chop bucket, where the market just really doesn't, lacks direction, it chops sideways, et cetera. When it gets over 30, they call it the FUCK bucket, and that's where things get dicey quickly.
Yeah, where the bears are in charge. Yeah,
correct. So we're in the chop bucket right now, but that 20 is kind of a watermark where people look and they say, all right, if it crosses that, I need to start to get a little bit more defensive in our nature.
Yeah, then the last thing, my boy Dan Bird on Sunday kind of let me see some of the data behind, again, because we were at all-time highs on Wednesday, right?
Correct.
And he showed some data that left me thinking 1987. So what does that mean, right? Black Monday. Apparently, and I'm going to go from memory, so the numbers will be off, but apparently we have the most leverage in the system today that we've ever had.
So I don't know that to be the answer or that to be the case, but that would not shock me at all. There's been just this mass proliferation of 2x levered NVIDIA, 2x levered SPY, 2x short, whatever. And all of those are a function of leverage. And then you can make the argument that the US government is levered to the gills as well on the other end. So there's leverage everywhere in the system.
Yeah. So one is leverage and the second is margin. The other thing that is at a record high is, retail investors are on more margin today than they have ever been. So when I think about the most margin and the most leverage, it doesn't take a lot to start the dominoes.
No, but I think that the counterpoint to that is you don't have the corporate balance sheets leveraged. True. So the underlying fundamentals of the companies aren't levered, and therefore you shouldn't see a mass hysteria default by underlying companies on their debt obligations or whatever. But what it does impact is the multiple. So how much are people paying for that dollar worth of earnings that Apple produces, that Meta produces, whatever? When leverage is wider, that's just going to add and feed that beast and have multiples continuously move higher. Right now, we're 1.54 standard deviations. My mother's a statistics professor, so I'll take that to a Z-score. That puts us...
She's so proud of you.
That puts us in a place where stocks have been less expensive 93% of the time throughout history. So people are paying more for every $1 a company earns than they have 93% of the time throughout history. And again, right, wrong, or indifferent, and whether you like Trump policy, you don't like Trump policy, it's hard to say that there's not, you use the word chaotic. It's hard to say he's not a gunslinger. It's what is that book? ready, shoot, aim. That's kind of his mentality where he shoots before he aims. And we need some of that because we came from this lackadaisical do nothing behavior before, but now we're on the other side of it. And we don't really know what all the impacts will be to these given actions, but the market is priced according to the multiple that, hey, everything is going to be perfect. And we'll see.
There you go. Well, it's going to be a very, very interesting year. Certainly very interesting first half. Taylor, where can people find you?
Yeah, find us on Instagram and on TikTok, LinkedIn, wherever you want to find us. We are at LifeGoal Investments.
Thank you, buddy.
Thank you.